Industrial didn't cool off in 2025. It matured. For the first time in years, the sector stopped outrunning itself and started digesting the world it built. And everything that happened this year comes back to one pressure. Supply finally caught up. 2025 opened like the first quiet breath after a sprint. Vacancy settled around 6.6%, not collapsing, not spiking, just stabilizing after 2 years of relentless upward movement. Because this wasn't a demand story, it was a pipeline story. Nearly 1 billion SQFT of new industrial space had been delivered since early 2023. By 2024, close to 400 million SQFT of it was still vacant. And 2025 was the year the sector finally had to absorb it. Absorption stayed strong, more than 53 million SQFT in Q3, but even that couldn't outrun the pace of deliveries. Developers had been building like the world would never slow down, and then it did. The story of 2025 was a divide. Modern warehouses, built since 2022, automation ready, high clear heights, heavy power, absorbed more than 200 million SQFT in recent quarters. Older buildings did the opposite. They lost over 100 million SQFT of tenancy. For the first time, occupiers said it openly. We'll grow, but not in obsolete space. This wasn't cyclical churn. It was structural obsolescence. And it reshaped everything. Leasing decisions, CapEx plans, valuations. Leasing stayed healthy, on track to exceed 800 million SQFTs in 2025. Below the pandemic frenzy, but far above the pre-2020 world. 3PLs led the charge, 35% of all transactions, as retailers outsourced for flexibility and cost control. E-commerce kept pushing space needs higher. Online sales reached 23-25% of core retail sales. Every percentage point means more throughput, more inventory, more demand for logistics. And supply chains changed their geography. Nearshoring in Mexico exploded. Border markets in U.S. interior hubs, Houston, Dallas, Kansas City, Louisville, all felt the pull. Demand didn't slow. It diversified. Industrial stayed the investor favorite. Values corrected slightly, a few percent, bringing cap rates into the mid 4% to low 5% range for prime assets. Debt at 6 to 7% forced the adjustment, but capital didn't flee. Industrial still led CRE in transaction volume. More than half of all net lease deals were industrial. Lenders tightened on speculative starts, and that's exactly why new construction starts dropped by more than half in 2025. The pipeline finally stopped growing. That single shift sets up the next cycle. Environmental pressure rose. The Inland Empire faced fees and restrictions to curb truck pollution. Cities added solar requirements for new industrial roofs. Communities pushed back on mega warehouses. But national policies pulled in the opposite direction. Trade tensions, reshoring, labor stability at ports, all strengthening domestic logistics demand. Industrial sat right at the intersection of these forces. Regulation on one side, restructuring on the other. 2026 isn't the boom returning, it's balance returning. Starts are down sharply, deliveries taper, vacancy begins to tighten again, especially in modern Class A space. Rent growth, which paused in 2024-25, pushes back into mid-single digits as the vacant new stock leases up. Demand stays structurally elevated, e-commerce 3PL expansion, nearshoring inventory resiliency, all now part of the permanent landscape. Older facilities will continue to struggle. Redevelopment becomes a strategy, not an exception. The floor for this sector is high, and the ceiling is still rising, just more slowly, more rationally. 2026 won't reward the markets that grew the fastest. It will reward the ones that grew the smartest. Industrial didn't slow down, it grew up.